Most people think hedge funds are playgrounds for the ultra-rich, places where billionaires casually toss money around. But that's a myth. Hedge funds are not built on luck or chance. They're built on control. While average investors hope, hedge funds calculate. They operate with one rule in mind: never lose. Not because they're smarter, but because they've created a system where the odds are always in their favor. In 2008, when the global economy collapsed, banks went under, and millions lost their homes. One hedge fund manager, John Paulson, saw it coming. He studied housing data, credit default swaps, and banking practices. Then, he bet against the housing market and made $4 billion in a single year. While the world was drowning, he was sailing past the wreckage in a private yacht. How did he know what the public didn't? Because hedge funds have access to information, models, and networks the average investor can only dream of. They pay millions to stay a step ahead. They use strategies like long-short investing. This means buying stocks they believe will rise and shorting stocks they expect to fall. It's not about guessing right. It's about balancing risks so perfectly that even if one part loses, the other gains more. They don't bet on winners. They build portfolios where failure is already accounted for. Think of it like betting on both teams in a match, but adjusting the bet sizes so you profit either way. This is not gambling. This is precision-engineered money movement. Look at Tiger Global in 2024. They made aggressive bets on AI and tech, backfired, billions in losses. But instead of panic, they pivoted fast. They dumped losers, analyzed sentiment, found new patterns, and reallocated. Their losses lasted 1 quarter. Most retail investors take years to recover from a bad call. Hedge funds do it in weeks. The difference isn't just in speed, it's in detachment. They don't love the companies they invest in. They don't follow hype, they follow signals. And when the market turns emotional, that's when hedge funds strike. They know human nature better than any algorithm. When fear hits, the public sells low. When greed hits, they buy high. Hedge funds exploit this. They map behavior. They've modeled what you're likely to do next, not just individuals, but entire populations. This isn't a conspiracy. It's a strategy. And here's the uncomfortable truth. The system allows it. Regulations are written by people with ties to finance. Transparency is limited. While you search Reddit and YouTube for stock tips, hedge funds are running simulations on millions of data points in real time. They move fast and disappear before you even realize the game changed. And if it ever gets too risky, they just hedge. They are not playing the same game as the public. When markets collapse, they're already positioned. When bubbles form, they're already exiting. They operate on algorithms, insider relationships, and speed.